Welcome to our session where we're going to look at an overview of financial management. So why do we study corporate finance or financial management? Basically, we want to prepare for the workplace tomorrow. So we use the information in here to understand the financial terminologies. By considering to study this, we should be able to understand the corporate financial and financial management goal. What is the goal of a firm? And what is the function, managerial or financial function of a financial manager. So you, in one way or the other, could stand in that position as a financial manager of a company. So you need to understand what the roles are. So to start with, corporate finance is simply defined generally as the activities involved in managing cash flows or money in a business. And there are five basic corporate finance functions. Number one, they include financing roles, financial management roles, capital budgeting, risk management, and corporate governance. So these are the basic functions to understand issues with financing. All right. To understand issues with financial management, capital budgeting, and these summarize the syllabus in itself. So let's define this. What is financing? Basically, we are looking at ways in which we could raise capital to support the company's operations. What is financial management? This includes managing a firm's internal cash flows and the mix of debt plus equity, harmonizing these to maximize what? The value for a firm. So it's basically about maximizing the value for the investors in these firms, who we call the shareholders. So capital budgeting involves you selecting the best projects that will be worthwhile to the firm, worth investing based on the perceived risks and expected returns. And risk management, you're basically managing the firm's exposure to the different types of risk, both insurable and non-insurable risk, in order to minimize um, the optimum risk. Corporate governance will be looking at how corporates or structures of a company will ensure that managers will behave ethically. This is where issues of uh, what do we call this? The obligation that shareholders have, obligation that managers have to shareholders in terms of performing to the best interests of the firm. So this course is very applicable. We'll start by looking at the overview, financial management. So there are three key decisions. They're what we call investment decisions. They're what we call financing decisions, and they are what we call dividend decisions. So what is involved in each of these ones? For those that attended my class, there are three key decisions, actually four, but three for now. We'll talk about what are involved in these. So when we're dealing with investment decisions, we're looking at capital budgeting. So we're looking at decisions that involve how a company should allocate its funds to the long-term assets of the project. So the goal here that you as finance managers have is to ensure that you invest in projects that will generate returns that supersede or that exceed the costs. So these uh, decisions are in favor of the shareholders. So in these decisions, you will carefully need to involve techniques like the NPV, how to measure the net present value. So here you'll be measuring the present value of the future expected cash flows minus the initial investment. So if you have a positive NPV, it means you need to accept the project. IRR is also part of the investment decisions, where you're going to look at a discount rate at which your NPV is zero. So all projects with an IRR that is higher than the cost of capital, you pick them. You also look at the payback period, which is the time that it will take for the firm to recover its initial investment. So a shorter period means it is more attractive. Then in terms of the financing decisions, what do you think is involved as a financial manager? What will you be looking at? You'll be looking at how to raise funds for your firm in terms of operations and investment. So it involves you choosing, do we get more of debt or more of equity? And these are strategic decisions that you need to make. So sometimes borrowing becomes cheaper than using equity financing because there are these antagonistic decisions where the agent principal relationship comes in. So managers there would, as much as possible, want to plow back the profits because of the fear that the debt that they will get may escalate. But the managers will need to act in the best interest because the shareholders are investing, expecting a return. So how do you now plow back the profits? Under what dividend, what policy are you operating? So financing decisions basically look at you marrying a mix. The key here is to find the optimal balance between debt and what? And equity, thereby minimizing the overall cost of capital because capital has a cost. So this is where I'll teach you work. All right, then there are dividend decisions here. These dividend decisions will involve you what? Deciding how much the company's earnings should be in terms of payment to the shareholders. We have different types of shareholders, preferential shareholders, equity shareholders, who we call common stock shareholders. So you need to make key considerations that will include your retained earnings, so the profits that should be kept in the company to fund the growth, to repay off some debt, and also the dividends in terms of profits that must be distributed to the shareholders to rewarding them for what? Investing. So these are the three key decisions that you are usually asked about in an exam. So investment decisions looks at what? Capital budgeting process. And financing decisions looks at what type of financing mix you're looking at. So how much of debt are you looking at? Then we've talked about what dividend, where you're going to determine the policy that the firm may want to adopt in terms of what? Rewarding the owners. So the managers will need to perform these roles. Now, what is the goal of a firm? What is the goal of a firm? So there are different goals that firms may have. Others are to maximize their share, price share. Others are to maximize value. Others to increase market share. Okay? There are many goals. Others are to just what? Break even. We call that satisficing behavior. So others are there to minimize costs, maximize sales. So these are different reasons why a firm may be in existence. So shareholders, both maximization. So there are advantages and disadvantages of this objective. So when you are into shareholder wealth maximization, you take into account the current and future profits. You're going to time the duration and the risks. You're going to look at the dividend policy and other relevant factors. So you are mainly concentrating on the share price that serves as a barometer of business performance. The disadvantage is that this could increase the current profits, but it will harm the firm. You're concentrating on profits that you share it amongst the shareholders using the dividend distributions. It also ignores the risks um, in the firm. It also does not fully consider the cash flow timings. So if your objective is mainly on maximization, those are some of the shortcomings. So now, in modern corporations, there has been a distinctive separation between the owners and the managers. So the shareholders are actually people whose names are entered in the register as being the holders of more than one share in a company by application through incorporation by a promoter of a private company. Management, on the other hand, is the agent that acts on behalf of these shareholders who are the owners of the business. So, as management, you're agents, individuals authorized because you've gone to school, you are learned people, you are acting in the management's behalf to run the affairs of business on behalf of the shareholder. So, the shareholder in this case is called the principal. You are the agent. So, we have what we call the agent principal relationship. So, here comes now what is called the agency problem. So, what is the agency problem, and how do we understand this from the background I've given you? So, this is a 15-mark question that desires us to really understand. Okay, what is the agency problem? So, Urgency problem um, arises when the shareholders are not in agreement with the managers. It arises often in companies where there is a conflict between the principals who are the shareholders and the agents who are the managers of the company. So in theory, what happens is that managers are hired to act in the best interest of the shareholders by doing what? Maximizing the wealth. But what actually happens in practice is that the guys want to maximize their own. So here is what happens. The problem here is managers want to pursue their own goals rather than the objective of the shareholder, which is wealth maximization. So one common example is misuse of corporate funds for non-value maximizing purposes like purchasing expensive corporate jets, operating luxury head offices, and incurring unnecessary travel, entertainment expenses. So this migration from the initial principal uh, reason why you're employed to personal and also securing their jobs. So to mitigate these urgency problems, shareholders may want to implement incentives. So they'll come up with what are called performance-based bonuses. Okay, they want to appraise you. They also inculcate monitoring mechanisms like audits, okay, or oversight committees that will come in, like PAC, to ensure that managers act in the best interest of the shareholder. So in short, the urgency problem highlights the need for proper governance and control that will align the two. So in the Western countries, they've done more than just this by coming up with independent bodies. Um, so what ways would you deal with this urgency problem? How will this problem be minimized? So sometimes structured managerial initiatives would include you having what? Executive share options where you give the um, managers an opportunity to buy shares at a discounted rate so that they too can assume the role of a partial shareholder, such that if they are harming the other shareholders, are harming themselves. Such an intelligent initiative. And also, they may also have other initiatives where they monitor these managerial decisions. They have external auditors. Okay, they have expenditures that will have to restructure the organization so that there's a possibility. If there's undesirable managerial behavior, they what limited by firing or taking them to court, all right, or threatening them with a takeover, a hostile takeover, where a company will be taken by another, a new board will be appointed, and they may lose their job. So these are some of the uh, initiatives that will be taken. Now, there's this concept that is called corporate social responsibility. So there, we talked about the objective of FMN is to do what? To maximize wealth. But there's an expectation that most uh, communities have that when an organization is operating, they're expected to act in their best behalf. This is what is called social corporate responsibility. Sometimes it feels so much like an entitlement. It is idea that while the primary goal of the firm is to maximize shareholder wealth, it should not prevent them from being what socially responsible. And firms are considered to be socially responsible when they promote private goods, not for profit, but for the community. So the shareholders' wealth maximization is P1. Nonetheless, they're expected to perform activities that will benefit society, especially in the mining area on the copper belt, where we have what we call externalities. The pollution of waters like we had where the US withdrew their people. So how do we pay them back, right? So companies are expected to act responsibly by fulfilling a role that is wider than an economic what role, by being responsible, sponsoring activities, developmental programs, road um, maintenance, and also ensuring that there's ethical labor practices. They also employ locally. They distribute education, health facilities. So, in short, CSR will encourage firms to benefit from making their profits by considering societal contributions. This will ensure that they add what? They add value to both the shareholder and to the wider community. So that is what we consider as CSR. Okay, So, although some people argue for to say why should we be responsible for doing tasks that meant for government? So arguments in favor of CSR is that to create a positive what? Public relations. The image will be attractive. There will be repeat sales and to improve staff recruitment. People will be motivated to keep organizations within the law. The argument against is that market capitalism is the most equitable form. So ethics of doing business are not to wider communities about making what? Profit. So you're not mandated. The role is to make profit. So government are responsible for the well-being of society. These private organizations are to make profit. So an organization's maximum requirement should remain within the law, not more than what is required. So these are some of the arguments that are there. So um, basically, this is the overview of this course. Then you should also have an idea of the types of businesses that we have. We have three basic businesses. We have a sole proprietorship, all right? We have a partnership, we have a corporation. At least from your previous, can you please tell me anything about these three entities? What's a sole proprietor? What's a partnership? And what's a corporation? So, sole proprietor is owned by a single individual who receives all the profits. What does it do? Bears all the losses. It's simple to set up with minimal regulations. The owner has unlimited liability, meaning the personal assets can be used to settle the debt. Partnerships can be owned by two or more who share what? Their profits and losses. What we call general partners and limited partners. The general partners will share equal responsibility and have unlimited liability. Whereas limited, one person can be limited with their own personal liabilities, okay? Then the other ones will be unlimited. The limited partner will be limited to how much they have put in. So partners will allow a pool of resources, skill, but they'll need to trust each other. Disagreements may come. Corporations is a separate body of people who we call shareholders in the company who can sue and be sued. They have limited liability, meaning the risk is up until what they have invested in the company. And they will easily raise funds using bonds, shares, and are subject to more regulations than these sole traders and partnerships. So these are the types of businesses that we have. Okay, let's go to our exercise quickly on question number um, 2. Okay, can we answer these last two questions here? Discuss ZTS. Okay, let's just look at it um, generally, but I'm interested in the last part more so. So ZTS is funding a 5,000 expansion within a 3-year bank loan at 12% compounded and repaid in equal quarterly repayments. The board supports the project but suspects senior management of impact building rather than maximizing shareholder wealth. So calculate the required quarterly payment and prepare an amortization schedule. Then discuss how this project and its funding requirements force management to address three major financial decisions. Then also define urgency problem in the context of ZTS and explain the obligation of significant quarterly debt repayments, how they can serve as a mechanism to mitigate the conflict between the managers and shareholders. So let's start with the last part. Okay, so questions will come indirectly based on what we have been discussing. So loan amortization is what I'll teach you in the next topic on time value of money. I'll come up with a amortization schedule, but I want us to explain how the project affects the three major financial decisions. So what three key decisions are made? We talked about what decision? Number one, investment decision. Number two, financing decision. And number three, the dividend decisions. So from that
Dividend.
case study, the management decision here will help management to evaluate whether that 500,000 expansion will it create value for the shareholders. Okay, using NPV or IRR before committing the funds. That's one thing they should consider. Management decision there will give the manager what? An insight to evaluating whether that amount that will be invested will create value to the shareholders. Secondly, financing decision. So financing decisions will help managers now assess, is choosing a 3-year bank loan at 12%, that's now a debt. Are we better off getting that debt, or we can easily um, consider a capital structure where we'll issue shares and monies will be used? So that comes from the financing decision. The dividend decisions there will really largely affect the large quarterly repayment. Will they reduce the cash available for dividends, forcing the trade-offs between paying the shareholders and the retained earnings? So that question was more on principle of what we talked about than in calculation on that part. Then let's go to the urgency problem. So question number part 3 is what I was interested in. It's asking to say, define the urgency problem in the context of ZTS and explain how the obligation of significant quarterly debt repayments can serve as a mechanism to mitigate conflict between managers and the shareholders. So the urgency problem is a potential conflict of interest between two people. The principals who are the shareholders and the agents who are the managers. So managers may act in ways that will increase their own what? Their own power or prestige in this empire building rather than to maximize the wealth of the shareholders. So how do we mitigate through this debt? So the large quarterly debt payments can force managers to generate a consistent cash flow, and the debt can act as a control mechanism. So excess cash could be spent on, say, non-value maximizing projects, and they can redirect the excess to the lenders. So this will align with managerial action. So you can explain this in your own other way, but the actual issue or contention here is to seeing how the urgency problem is created in this scenario. I could give you a different case, okay? Uh, I don't know if somebody can answer it differently, but the urgency problem is where you have a conflict between the shareholders and the agents. So it arises when the interests of the managers, who are the agents, do not fully align with those of the shareholders. So in this case, ZTS managers would want to pursue their personal goals, like expanding the company just for prestige. I've seen that company, what bank is that? Is it Indo in Cairo? Rather than focusing on maximizing shareholder. So that's where the urgency problem may come. Now, how do we mitigate this problem? Okay, this debt, how does it become a mitigating mechanism? So the obligation that managers may have would be to make substantial quarterly loan payment. This would reduce the amount that is available to um, for the managers to spend on non-essential projects. So there will be external pressure that will come from the shareholders, that instead of having to repay huge sums of money to paying back that loan, why don't you find other means so that you balance up paying debt and the discipline of having to also consider the interests of the shareholders? Okay, so now we'll go to the second unit. This was the introduction part. Um, Time value of money, unless there are any questions on that.